In the US, the opponents of gun control like to say that guns don't kill people, people kill people. I think it's people misusing guns who kill people. In the same way, it's not accounting that creates abuses, but people misusing accounting. With this thought, let me welcome you to the second part of this video series on explaining how to read and analyze a balance sheet. In the previous video, we read through the equity and liabilities side of the balance sheet. Now, as you know, there is a balance in the balance sheet. Something must equal something else or it doesn't balance. So while equities and liabilities form one side of the balance sheet, the other balancing side is called assets. In this video, let me take you through the asset side of the balance sheet. The example I am using here is that of opto circuits. In simple terms, assets are what a company owns. So assets are what company owns. So these assets belong to the company. As we discussed in the previous video on equity and liabilities, those are what a company owes. So equity and liabilities are something which a company owes. So these are like sources of funds, and your assets are like the utilization of those funds. A company uses assets to conduct its business towards producing a profit. So that's a simple fundamental of an asset. From an accounting standpoint, an asset must have three characteristics. So there are three characteristics of assets as far as accounting is concerned. Three characteristics of assets. What's the first characteristic? First is it has to have a value. Have a value. So something to be called an asset needs to have a value towards producing a return for the business. The second characteristics of an asset is it should be in a company's control. So company's control. Very important part again. An asset should be something which should be in a company's control. So a leased airplane is still an asset even if it's not legally owned by the company, but just because it's under a company's control. What's the third characteristic of an asset? The third one is it should be recordable and have a value. So there should be recordable value of it. Recordable value. Now employees don't show up as an asset on the balance sheet because you can't really value an employee, despite the fact that CEOs frequently refer their employees as assets. Now broadly, there are two kinds of assets on any company's balance sheet. If you were to see this balance sheet of opto circuits, there are basically two kinds of assets which you can see there. The first are non-current assets. So you have the just a sec. You have the non-current assets here, and the second are the current assets. Non-current assets include longer term fixed assets that are very important for a business and thus do not move in and out of a company on a day-to-day basis. These are assets like long-term investments or non-current investments, fixed assets, and goodwill and other intangible assets. So we'll be understanding non-current assets in detail, but this was broadly a definition of what non-current assets really are. Current assets, on the other hand, are short term in nature. So you have non-current assets which are long term in nature, which are made up of fixed assets, tangible assets, intangible assets which don't move out of a balance sheet on a daily basis. On the other hand, you have current assets which are short term in nature, which are actively managed and directly tied to the current level of business. A good way to think of current and non-current assets is this. Current assets like cash are the lifeblood of the business, while non-current assets are the body through which they circulate. Let us start from the first item, the asset side of opto circuits balance sheet, that is non-current assets. Herein, if you see, the first item reads fixed assets. So there are fixed assets, which is the first item in the non-current asset segment. Now fixed assets are made up of three subsegments. There are tangible assets, there are intangible assets, and there's something known as capital work in progress. Let's start with the first item, which is tangible assets. Tangible assets basically represent the bricks and mortar of a company: land, buildings, factories, furniture, equipment, and so forth. Now, if I were to take you through the fixed asset schedule of opto circuits, you'll see that there are some things which there are some subcategories within the tangible asset category, and these are land, the leasehold premises, the borewell, the buildings, the apartments, the office buildings, plant and equipment, furniture, fixtures, computer, electrical installations, vehicles, office equipments. So these are all tangible assets. The tangible assets on the balance sheet are typically reported net of accumulated depreciation. So in simple terms, on all fixed asset, tangible assets, a company needs to provide depreciation, which is accounted as a replacement value in the future. So the amount of tangible assets that you see in the balance sheet is the net value after reducing depreciation. So this value of tangible assets, row number 10, is the net value after reducing depreciation. So this is the net value, or 456 crore is the net value of tangible assets. Eventually, a company's tangible assets like plant and machinery have to be replaced, right? And depreciation is the company's best estimate of these replacement costs from wear and tear. Keep in mind that tangible assets as appearing on the balance sheet are usually not a very accurate measure of what a firm's bricks and mortar are really worth. Many times, buildings worth millions of dollars are reported at next to nothing in the statement showing tangible assets because of accumulated depreciation. Likewise, the actual value of a company's land, which is recorded under tangible assets at its acquisition price, may be worth exponentially more than what is recorded. Moving on to intangible assets. Now, what are they? Just as the name describes, intangible assets are those that can't be touched and are generally not going to turn into cash. Now, going back to the statement of assets, fixed asset, tangible and intangible assets opto circuits, we see there's something called as intangible assets here. You see something called as goodwill, their brands and trademarks, their computer software, their copyrights, patents, their recipes, formula, models, designs, and there's something known as customer relationship, which are intangible assets. So these are assets which lie in the balance sheet of a company, but you can't really touch and feel these kind of assets, right? So that's the reason they are known as intangible assets. You can't touch and feel a company's customer relationships, right? Despite that, these are assets for a company, as these relationships helped it earn higher profits. This is just like life, wherein we never count intangible assets like family, relationships, friends, trust, respect, health, etc. in our personal balance sheets. This is because we know we own such assets but don't know how to put a value to each of them. But it is these intangibles that are our real long-term assets. Everything else just comes and goes out of our lives. Anyways, the size of tangible assets to a company's total assets will depend on the type of a business. So we are again talking about the tangible assets, fixed assets. So a size of a company's tangible assets to fixed assets, so your tangible assets to your fixed asset, will depend on which industry it's working in. So for example, most of the assets of an airline company or an Indian IT services company will fall into this category, because they need to have a lot of tangible assets on their business to carry on their business. On the other hand, for example, an advertising agency will have far few tangible assets. They require nothing but their employees, some pencils and a few computers. You must be very careful not to pay too much attention to this number of tangible assets. So this number of tangible assets, don't pay a lot of attention to these. Since companies are often unable to sell their tangible assets within any reasonable amount of time, after all, who would be willing to buy 3 notebook binders, a factory, some plants, the broom at the moment's notice? They are often carried on the balance sheet at cost, regardless of their actual value. So it is possible for companies to grossly inflate this number, which is called watering the stock, by adopting lower depreciation rates or to write the values down to nothing. So while analyzing a balance sheet, you will want to look at this number of tangible assets with a raised eyebrow. Don't completely ignore it. That would be foolish. but certainly don't take it too seriously. Now, moving from tangible and intangible assets, we move to the third sub-segment of fixed assets, which is capital work in progress. Now, as the name sounds, capital here refers to large assets that provide a future function for the company, like tangible assets, and they include things like property, plant, and equipment. On the other hand, work in progress, the work in progress in capital work in progress means any construction or assembly not completed at the end of the financial year. So if there's some work in progress in terms of setting up a plant and machinery, setting up an office building at the end of a year, and the work is still in progress, that will be referred to as capital work in progress. It essentially represents capital assets that are in process of getting built or constructed on the date of balance sheet preparation. So this entry allows, the entry of capital work in progress basically allows the company to keep track of assets even though they are not yet completed. Let's move down to the next item under non-current assets, which is called goodwill on consolidation. So you have the figure of goodwill on consolidation. Now what exactly is it? As we discussed above, there was something called as goodwill under intangible assets, right? But that is the company's own goodwill created out of the respect the company commands in the market. So if you were to go back to look at the schedule of tangible and intangible assets for opto circuits, you see something called as goodwill, right? Which is a figure of around 6 million rupees. So now this goodwill is something also something which is the respect that opto circuits commands in the market. What we are discussing here now, after talking about tangible and intangible assets, is called goodwill on consolidation, which is a different number altogether. This goodwill on consolidation is basically something which is created when a company buys another company and pays more than the target company's worth. For instance, let's discuss with this with an example. For instance, if a company B, so there's company B, so we're talking about goodwill. So assuming there's company B, right, which has a net worth, which has a net worth of say 100 rupees. So rupees 100 is the net worth of company B, and there's this company A which wants to purchase this company B, or which purchases this company B for acquires, right, acquires at rupees 150. So if company A acquires company B at 150. Now you know the net worth of company B is just 100 rupees, but company A is willing to pay a higher price for that net worth, and it requires company B at say 150 rupees. Now when you combine and when you create a consolidated account statement of company A, right, so what will happen is rupees 100, which is the value of equity and also assets of company B, will go into the asset side, right? So your fixed asset side, your fixed asset, and also go towards, and on the liability side it will go as equity, because equity or net worth, because it has been bought out, worth rupees 100. What happens to the excess 50 rupees? Rupees 50 will go as goodwill on consolidation. Pardon my handwriting, please. Yeah. So this 50 rupees is nothing but the excess amount that company A has paid for net worth of company B. You should view this line item, which is goodwill on consolidation, with high levels of skepticism, because most companies tend to pay too much when making acquisitions, like Opto has also done with its acquisitions in the past. So if you see Opto Circuits balance sheet, they have a lot of goodwill on consolidation lying there. Of course, it was higher at 626 crore. Now it has come down. Now we'll also talk about the reason of goodwill coming down. Accounting rules actually require companies to value goodwill every year. And if a company lowers the value of the goodwill it records, like what Opto has done, it's a phenomenon called impairment. It's an unspoken admission that the company paid too much for an acquisition it made in the past. Now, if you see, by reducing the amount of goodwill on the balance sheet, or by simply impairing it, as they say it in accounting parlance, what OptoCircuits is admitting is that it had paid higher for its acquisition, and now because the net worth and actual growth of the acquired companies have not been in line, it has to actually reduce the amount of goodwill, write off the amount of goodwill. In cases where a company writes off a part of its goodwill, like Opto has done, from 626 crores, so it has impaired its goodwill from 626 crore to 449 crore. An equivalent amount of money is written off from reserves. So as we know, there's a double entry system in balance sheets or financial statements. So for every transaction on the liability side or asset side, there has to be an equivalent transaction on the asset side or liability side, or vice versa. So if there is an impairment, there is a reduction in the goodwill value on the asset side. There has to be some reduction in the some value on the liability side. So where does the reduction happens? The reduction happens on the reserves and surplus side. This is where the company writes off the amount equivalent to the amount of goodwill impairment, right? So which means the company's reserves will come down, or the reserves which it had actually created for future uses has been impacted just because the company has to lower the goodwill amount, just because the company actually realized that it has paid much higher prices than was warranted for an acquisition. Survey after survey after survey show that most acquisitions fail globally for reasons like flawed business logic, flawed understanding of the acquired business, or flawed integration of the acquired businesses. So a lot of acquisitions, like a lot of stock market investments, also fail because the acquirer pays a big price for the acquired company, and future profits and cash flows of the latter are not able to justify the same. That's why, as an investor, you must always be concerned when a company makes large acquisitions, like Opto did. This is not only because the acquisition will take away precious management time from its core business, they will also create goodwill on consolidation on the balance sheet, which will be sooner or later get impaired, as history suggests. Personally, I see a size of an acquisition representing the size of an CEO's ego. Every CEO wants to make his company big, and in this ego to do this, he often takes missteps that prove detrimental to the company and its shareholders' future. So the moment you see a company acquiring big time, add a greater margin of safety to your chosen investments and review your decision to buy or hold on to the same. After discussing goodwill, let's now move on to the next item on the non-current asset side, which is the non-current investments. So you see a figure of non-current investments. Non-current or long-term investments represent the money invested in either bonds with long terms than 1 year or the stock of other companies. These aren't as liquid as cash and short-term investments. So these non-current investments, also known as long-term investments, so these are also known as long-term investments, are not as liquid as short-term investments or cash, and the prices may fluctuate. So it's possible that the value shown on the balance sheet may be too high or too low. So again, for non-current investments, it does not really make sense to go by the face value of the amount which is shown in the balance sheets. For example, the amount for Opto is pretty low, as 1,09,000. So not really, I won't be bothered by this amount, but yeah, it makes it you need to be very careful while looking in non-current investments in other balance sheets where the amount is huge, because these might not be shown at the right value. Sometimes they might be too high, or sometimes they might be too low. If it's a big enough balance, you may want to dig into the details to make sure you are comfortable with the kinds of risks the firm is taking with its excess cash. Now, if I were to look at OptoCircuits statements, so if I were to look at schedule number 11, which shows, so where's schedule number 11? This is 10 and this is 11. Yeah, just a second. So yeah, if I were to look at schedule number 11 here, which shows me non-current investments, I can see there are two small investments of 7,000 rupees in Centum Electronics and Microlend, which is 1,02,000 rupees. So these are pretty small investments, probably made in group companies or private companies which belong to the promoters. So I won't be really worried about this item on Opto's balance sheet, but if the amount is too large for any other company, just understand what exactly are those investments into, or where exactly has the money been poured into in the name of long term in the name of non-current investments or long-term investments. Moving to the next item on the balance sheet on the asset side, which is deferred tax assets. Now deferred tax asset is like an excess tax that the company has paid, and it arises due to timing difference in the value of assets as per the balance sheet and as per the Income Tax Act. As we discussed in the description of deferred tax liability in the previous video, depreciation is again the main reason for creation of a deferred tax asset. Let me again explain with an example. I of course explained in the previous video, but it's always good to refresh the things. Suppose the company purchases a car. Now let's look at, so again I'll draw a car. So company purchases a car for rupees 10 lakh. Yeah, rupees 10 lakh. Now depreciation on this car, now the depreciation on this car as per Companies Act is at say 20%, which means depreciation will be 20% of 1 lakh, which is rupees, sorry, 20% to 10 lakh, which is rupees 2 lakh. And depreciation at the rate or as per Income Tax Act. Now the two depreciation rates as per Companies Act and as per Income Tax Act. So Income Tax Act is at the rate of say 15%, which makes it rupees 1.5 lakh. 15% of 10 lakh, which is 1.5 lakh, and the difference here is 50,000, right? 2 lakh minus 1.5 lakh is 50,000. So what will the deferred tax asset? Deferred tax asset will be, so your deferred tax asset equals to, and deferred tax asset at the rate of the company's income tax rate of say 30% will be equals to 30% of 50,000, which is equals to 15,000. This 15,000 will be recorded as deferred tax asset on the company's balance sheet under the asset side. What this 15,000 of deferred tax asset means, it means that the company will definitely have the tax refund of that much in the future years. In case the difference above was negative, so instead of say positive 50,000 here, if it was a negative 50,000, there would have been a 15,000 worth of deferred tax liability. So the 15,000 instead of being a deferred tax asset would have been a deferred tax liability, right? Deferred tax liability, as we discussed in the previous video. In Opto's case, so now let's look at where Opto stands. In Opto's case, there was zero deferred tax asset last year, and there's a deferred tax asset of 158 crores this year, which means this is the amount of money which the company must have paid in advance because of difference in Companies Act depreciation rate and Income Tax Act depreciation rate, and this is the amount that the company will receive in the future. But since it will receive in the future, it has really marked it as asset on its balance sheet. Moving from deferred tax asset, now we'll talk about the next line item. So we've discussed deferred tax asset. The next item is long-term loans and advances. These basically refer to loans and advances the company has offered to its group companies and which it expects to get back in more than 1 year. Sometimes Uh, the long-term loans and advances also include a part of any advance tax the company has paid. So long-term loans and advances again basically are loans and advances which the company has given to its associate companies, group companies, and which will be repaid in more than 1 year. Or sometimes it also includes part of advance taxes for which the company will get a refund in more than 1 year. Uh, Moving on to the final segment of the non-current assets, we look at other non-current assets. Now there's schedule 13 where which really explains. So here we are on schedule 13, which really explains what exactly is non-current asset for the company. As you can see in the schedule 13, the non-current assets represent items like long-term deposits. So you have something like long-term deposit here. Then you have items like advance towards capital goods, some loans and advances, taxes paid in, again some part of taxes paid in advance, and some part of deposits where the company has deposited money and it'll receive money in say more than 12 months. So these are all part of non-current assets which the company has. With this, we conclude the discussion on non-current assets. So we've finished the discussion on non-current assets as they are seen on the asset side of the balance sheet. Let's now move to current assets, which, as I mentioned earlier, are short-term in nature. So we talk about current assets, which are short-term in nature, and actively managed and directly tied to a current level of company's business.